Imagine a scenario. It's, I don't know, a Tuesday afternoon. You're walking through a neighborhood you've always loved but can never quite afford.
Hmm.
You turn a corner, and there it is. The house. It's got good bones, a sprawling porch, maybe a little overgrown, but it's just perfect. You can see the potential.
But there's always a catch.
There's always a catch. The neighborhood is, let's call it transitional.
Transitional. That is a very polite way of saying risky.
Exactly. There are rumors. Maybe the city's going to build a massive new park right across the street in 6 months, which would send property values into the stratosphere.
Okay, that's the dream scenario.
But there's also a rumor they might cancel the subway extension project, and the values could just tank. You want the house. You desperately want that upside if that park gets built. But are you willing to commit, say, $500,000 right now today with that dark cloud of uncertainty hanging over your head?
That is the classic investor's dilemma, isn't it?
Yeah.
Is that paralysis of risk versus commitment.
Yeah.
You want the exposure to the opportunity, but you're terrified of the obligation if things go south.
Precisely.
Yeah.
So what if...
Yeah.
What if you could do something different? Imagine you walk up to the owner who's maybe looking to sell but isn't in a rush. You make them a proposition. You say, look, I am not going to buy your house today for $500,000. That is just too risky for me right now.
Okay.
But here's $5,000, cash, non-refundable. In exchange for this $5,000, I want a contract. I want the exclusive right, but not the obligation to buy this house for $500,000 at any point in the next 6 months.
Okay, so let's play this out. The owner agrees.
Yeah.
He takes your $5,000, puts it in his pocket. He can't sell the house to anyone else for 6 months. He's locked in.
Right. He's obligated to me. Now, fast forward 3 months. The city announces the park is approved. It's going to be beautiful. Real estate agents are swarming. The house is suddenly worth $600,000. What do I do?
Well, you're a rational person. You exercise your right. You go to the owner with your contract in hand. You buy the house for that agreed-upon price of $500,000.
And I could just turn around and sell it immediately.
Immediately for $600,000. You've made a massive profit, all based on that initial $5,000 contract.
But let's look at the dark timeline. The subway is canceled. The neighborhood stagnates. The house value drops to $400,000.
In that case, you look at your contract and you look at the market. Why on earth would you pay $500,000 for a house that's only worth $400,000?
I wouldn't. It'd be crazy.
You wouldn't. You just walk away. You can literally tear up the contract.
And what did I lose? What's my total damage?
You lost the $5,000 you paid up front. That's it. Your loss is capped. You didn't lose $100,000 on the property value crashing. You essentially bought yourself an exit strategy for $5,000.
That right there, that ability to control a massive asset for a tiny fraction of the cost with a built-in safety net, it sounds like a magic trick. Or some kind of loophole. But it isn't. It is the absolute bedrock of the modern financial system. Welcome back to the Deep Dive. Today, we are opening up the hood on the financial engine that makes this all possible. We're looking at what many consider the Bible of derivatives, John Hull's options, futures, and other derivatives, specifically Chapter 10, Mechanics of Options Markets.
And our mission today is really specific. I think a lot of people toss around words like call, put, short, long. They see them on, Reddit. They see them on financial news. They hear friends bragging about these huge gains.
Oh yeah, the 1,000% returns.
Exactly. But we're going to move past all the buzzwords today. We're going to dismantle the machinery. We want to understand the gears, the plumbing, and the mathematical reality of how these instruments actually function. We're not just talking about how to gamble. We're talking about how risk is mechanically transferred from one person to another.
Okay, let's start unpacking that. Before we get into the real nitty-gritty of calls and puts, we should probably set the stage. We've talked about futures contracts in previous deep dives. In my head, futures and options were always kind of in the same bucket. They're both derivatives, right? They both involve agreeing to do something later. So what's the actual fundamental difference? Why do we even need both?
It's a great question, and I think the distinction is it's everything. It all comes down to a single powerful concept, obligation versus a...
Obligation versus... Right, okay.
If you enter into a futures contract, you are signing a binding agreement. You are locked in. You must buy or you must sell that asset at the specified date. It doesn't matter if the market has crashed or if you've changed your mind or if you ran out of money. You are on the hook.
So futures are kind of like a handshake deal with the mob. You can't back out.
That's a good way to put it, yes. It's a very linear relationship. If the price goes up by $1, you make $1. If it goes down by $1, you lose $1. And because it's this mutual obligation, It usually costs nothing to enter the contract. I mean, aside from posting some margin for safety.
Right.
No money changes hands at the start because both sides are equally locked in.
Yeah.
Options are completely different.
Mm-hmm.
An option is a right. It's a privilege. As the holder, you can do something, but you don't have to. And that freedom, the freedom to look at the market price in 6 months and just say, nah, no thanks, that freedom is incredibly valuable.
And because it has value, you can't get it for free.
Exactly.
Right.
In financial markets, there is no free lunch. If you want the choice, if you want that flexibility, you have to pay for it up front. And that paying is called the premium.
Okay, so if I'm going to remember one thing from this intro, it's futures are free to enter but carry this heavy weight of obligation. Options cost money to enter but grant you the freedom of choice.
That's it. Freedom isn't free. It's a pretty good life lesson wrapped up in financial theory.
It really is. Okay, let's look at the roadmap for this deep dive because Hall covers a massive amount of ground in this chapter. I think we should break this down into 4 main chunks. First, the anatomy of the option itself, the terms, the types, the specs, you could say.
Okay.
Second, and this is the big one, we're going to look at what I'm calling the grid, the 4 basic positions you can take in the options market.
The grid is where most people get lost, I think. Everyone understands buying something, but when you start talking about selling rights that you don't even own, that's where it gets a little spicy.
Right. And then third, we'll get into the math of the payoffs. We need to see the numbers to really understand who makes money and how. We're going to try and construct a specific table to help you visualize the risk.
Good.
And finally, we'll look at the plumbing, all the stuff nobody ever talks about. What happens when a stock splits? Or when a company pays a dividend? And who is this mysterious OCC that apparently prevents the whole system from collapsing?
You know, that last part, the plumbing, it's so often overlooked, but in Hull's work, it's essential. You really can't understand the risk if you don't understand how the contract adjusts, or more importantly, doesn't adjust, when the world changes around it.
Okay, let's jump in then. Part 1, the anatomy of an option. We've got 2 main characters in this story, the call and the put. Let's define them, but let's do it really strictly so we don't get confused later on.
Absolutely. Let's start with the call option. A call option gives the holder the right to buy an asset by a certain date for a certain price.
The right to buy.
Right. The way to remember is you're calling the asset away from someone else. You buy a call if you're bullish, if you think the price of something's going up. You want to lock in a cheap purchase price today for a transaction that will happen in the future.
Okay. And the other side of that coin is the put option.
Exactly. A put option gives the holder the right to sell an asset by a certain date for a certain price.
The right to sell.
You can think of it as you have the right to put the asset onto someone else.
Yeah.
You buy a put if you think the price is going down, or, and this is a really key use case, if you want to protect something you already own. It's like buying an exit ramp. If the market crashes, you have a guaranteed sale price locked in.
So call is for buying, put is for selling. Simple enough, but Hall lists a few other specs that are just non-negotiable parts of these contracts. If I look at an options chain, what am I actually seeing? What are the key details?
Every single option contract has 4 key defining features. You have to know all 4 to know what you're dealing with.
Sure.
1, the underlying asset. What are we actually talking about here? Is it Nebula Tech stock? Is it gold? Is it the S&P 500 index?
Right.
2, the expiration date. Sometimes people call it the maturity. That is the hard deadline. After that date, the option is dead. It just ceases to exist. It turns back into a pumpkin. 3, the strike price, or the exercise price. This is the price that was agreed upon in the contract. In your house example, that $500,000 was the strike price. It's the pivot point for the entire trade.
And what's number 4?
And 4 is the type, which brings us to a really weird bit of naming convention that trips a lot of people up. American versus European.
Yeah, I paused on this part of the chapter because Hall makes a specific point that this has nothing to do with geography, right? So I could be sitting in Paris trading an American option, or in New York trading a European one.
Exactly. It's a complete misnomer. It has absolutely nothing to do with where the trading happens. It's a naming convention about when you can exercise the right that you've purchased.
Okay, so what's the difference?
An American option can be exercised at any time up to and including the expiration date. So if the option expires in 6 months and the stock spikes tomorrow, you can exercise it tomorrow. You have total flexibility. You hold the ticket and you can walk into the show whenever you want.
Okay, that sounds pretty good. What about the European one?
A European option can be exercised only on the expiration date itself. It's much, much more restrictive. Even if the stock spikes to $1 million halfway through the life of the contract, you can't touch it. You have to wait until the very end. It's like having a ticket to a show that only opens its doors for like 1 minute at midnight on the last day of the month.
So, looking at that, why would anyone ever want a European option? American sounds strictly better. You have more flexibility. If I have the choice between any time and one specific day, I'm taking any time every single time. Why do European options even exist?
That's a very, very astute observation. And from a trader's perspective, you're right. American options are strictly better in terms of utility. They offer you more control. In fact, most of the exchange-traded options you'll see, like individual stock options on the CBOE, for instance, they're American. You can exercise them whenever you want. But European options are much, much easier to analyze mathematically because you only have to worry about the price at one single point in time. The very end, the formulas for valuing them, like the famous Black-Scholes model, are simpler and cleaner. So Hall, and a lot of financial theory, spends a lot of time on European options because they help build the theoretical foundation.
So they're easier to model.
Much easier. But in the real world of creating individual stocks, you're mostly dealing with American options. It's worth noting, though, that a lot of big index options, like on the S&P 500, are actually European.
Okay, so we have the definitions down. Now here is where it gets really interesting for me. We need to talk about the participants, because it's not just buying an option. There's this grid of 4 possibilities.
The matrix of participants. This is absolutely where beginners can get turned around. For every single contract that exists, there is a buyer and there is a seller.
Well, wait, you just said you can buy a call or buy a put, so that's 2.
Correct. But think about it. If you buy a call, who did you buy it from? Someone had to sell you that call. In the industry terms, the buyer is said to be long the option, and the seller is short the option. Sometimes the seller is also called the writer.
The writer, like they're writing an insurance policy.
That is the perfect analogy.
Huh.
The buyer is the person buying insurance. The writer is the insurance company taking on the risk and collecting the premium. So that structure gives us 4 distinct positions.
Okay, let's list them.
1, you can be a long call. You're buying the right to buy.
Okay.
2, you can be a short call. You're selling that same right to someone else. 3, you can be a long put. You're buying the right to sell. And 4, you can be a short put. You're selling the right to sell to somebody else.
I think we need to make this really concrete. Hull provides some great numerical examples to illustrate the payoff, and I think we should walk through them. Let's do our own original payoff example 1. I'm going to call this one the optimist.
Let's do it.
So imagine our fictional company, Nebula Tech. It's currently trading at exactly $100 a share. I am the optimist. I think Nebula Tech has just invented, I don't know, cold fusion or something. I think this stock is going to the moon. So I buy a long call with a strike price, the letter K, of $100.
Okay, pause right there. You're locking in the right to buy shares at $100. But remember, this isn't free. You have to pay the premium to the writer of the option.
Right.
Let's just assume, for this example, the premium is $5 per share.
Okay. So I pay $5 now. That money is gone. It's out of my account. I have the right to buy at $100. Let's play out outcome A. The stock actually does go to the moon. It hits $120. Walk me through the math. What do I do?
Well, you're a rational economic actor. You have a piece of paper that says you can buy something for $100. That exact same thing is currently being sold everywhere else for $120. What do you do?
I exercise my option.
You exercise it. You buy the stock at 100. You can immediately turn around and sell it in the market for 120. You've just made a gross profit of $20 per share.
But I paid $5 to get into the club in the first place.
Correct. So your net profit is that $20 gain minus the $5 premium you paid. You walk away with $15 of profit per share.
Not bad at all. I essentially tripled my investment. I put in $5 and I got $15 out. That's a 300% return. If I had just bought the stock at 100 and sold at 120, I would have made $20 on a $100 investment. That's only a 20% return.
And that is the drug of options, leverage. You controlled a $100 asset for just $5. You completely amplified your capital efficiency.
But now let's look at outcome B. Nebula Tech explodes on the launch pad. The cold fusion was a total hoax. The stock drops to $80.
Now you look at your right. You have the right to buy the stock at $100. But the market price is $80. Why would you ever force yourself to buy something for $100 when you can just go buy it on the street for $80?
I wouldn't. That would be just plain stupid.
Exactly. So you do nothing. You let the option expire, worthless. You don't exercise.
So what did I lose? What's the
Oh,
damage?
you lost your premium, the $5. And this is the real aha moment for the long call. Your loss is capped. It is strictly limited. The stock could go to 50 to 10 to 0. Nebula Tech could go bankrupt. You still only lose that $5, but your gain.
It's unlimited.
Theoretically, it's unlimited. If Nebula Tech went to $1,000, you'd still be buying it at 100.
That asymmetry is just, it's fascinating. Limited risk, unlimited reward. It feels like a gamble where the casino tells you the absolute maximum you can lose before you even pull the handle.
A very good analogy.
Okay, now let's flip it. Let's look at original payoff example 2. I'm calling this one the insurance policy.
This would be the long put.
Right. So imagine I own shares in, let's call it Old Guard Oil. It's a steady company trading at $50. But I'm nervous. Regulations are changing. The world is going green. I'm worried the price might crash. I don't want to sell the stock yet. Maybe I want the dividends, or maybe I'm hoping I'm wrong, but I want to be able to sleep at night. So I buy a long put with a strike price of $50.
Okay, so you're buying the right to force someone else to buy your stock at $50, no matter what happens to the market. Let's say this peace of mind costs you a premium of $3.
Okay, so outcome A. My fears come true. The stock crashes. It goes down to $30.
In the open market, your stock is just melting away. Everyone is panicking, but you hold this contract. You exercise your right to sell at 50. You could literally go into the market, buy shares at 30, and immediately hand them to the option writer who must pay you 50 for them.
So I make $20 on that transaction.
Minus the $3 premium you paid. So your net profit is $17. Or, more likely, if you already own the stock, you successfully protected your $50 value. You effectively sold at $47, $50 strike minus the $3 cost, even though the market is down at 30.
Now, what about outcome B? The regulation fails. Old Guard Oil finds a huge new reserve. The stock rallies to $70.
You have the right to sell your shares at 50, but why would you? The open market is paying 70. You just ignore the option, let it expire, tear it up.
Yeah, I lose the $3.
You lose the $3 premium. But that's just the cost of insurance. You don't call your car insurance company at the end of the year and complain that you didn't crash your car, right?
No.
You don't say, oh man, I just wasted all that money on Geico. You paid for protection, you didn't need it, and you move on, happy that the worst didn't happen.
So that covers the buyer's side pretty well. Buyers are looking for that leverage or for protection. But for every single buyer, there's a seller, there's a writer. So let's look at it from the writer's perspective. Why on earth would anyone sell an option? We just established that the buyer gets limited risk and potentially unlimited reward. Doesn't that mean the seller gets the exact opposite?
It does. And to understand the writer, you have to understand the casino. The writer receives that cash up front. They get the premium, that $5 from our Nebula Tech trade, that goes straight into the writer's pocket immediately.
Yeah.
If the stock stays flat or goes down or doesn't go up enough, they just keep that money. It's pure income.
But the risk, the risk on that short call.
The risk is the exact inverse of the buyer's. If you buy a call, you have unlimited upside. That means the person who sold you that call has unlimited downside. If Nebula Tech goes to $1,000, the writer is on the hook. They still have to sell it to you at $100. They have to go into the market, buy it for $1,000, and hand it to you for $100. They lose $900 instantly.
So the writer is basically picking up pennies in front of steamroller.
In a naked position, yes, that is the classic description. That's why writing naked options, selling options, without owning the underlying stock, is considered one of the absolute riskiest things an individual can do in finance. But most writers aren't naked. They're what's called covered.
Okay.
For instance, if I already own the stock and then I sell you a call against it, I don't care if it goes to $1,000. I just give you the stock I already have. I've capped my own upside, sure, but I didn't risk bankruptcy. We'll get to that in the margin section, but it's a really crucial distinction.
Before we move on to the risk table, we should probably formalize the math. Hull gives us these clean little formulas for the payoff. I usually kind of gloss over formulas, but these are actually they're just logic written in code. They're really simple.
Yes, and they are absolutely worth memorizing because they clarify the entire logic. For a long call, the payoff at expiration is max, STK, $0.
Okay, break that down.
S-day is just the stock price at time T, which is expiration. The S-day is the strike price. So think about it. If the stock price is higher than the strike, S-days, that difference is positive. You make money.
Right.
If the stock is lower than the strike, that difference is negative. But the max function just says take the higher number between your calculation and 0. You'd never exercise an option for a negative payoff, so you just get zero. You walk away.
And for the put, it's just the other way around.
It's simply flipped. The payoff for a long put is max, KST. If the strike price is higher than the stock price, meaning the market dropped, you make money. If the stock price is higher, the math goes negative, and that max function resets you back to zero.
Max of zero. That is the perfect mathematical way of saying I have the right to walk away.
I love that. It's very elegant.
Okay, so let's try to visualize this with the risk profile table. I want you, the listener, to picture a grid with 4 rows: long call, short call, long put, and short put. We need to describe the payoff, the max risk, and the general P&L profile for each of these. This is the table you need to burn into your brain. Let's start with the long call.
Okay, long call. The payoff formula is what we just said. Max, STK, $0. The payoff formula is what we just said. The max risk, your maximum loss, is strictly limited. You can only lose the premium you paid. You can never, ever lose more than the cost of your entry ticket. The payoff formula is what we just said. And the P&L profile is unlimited upside. The graph is a flat line at a small loss, and then once the stock passes the strike price, it just shoots up at a 45-degree angle, theoretically to infinity.
Now the short call, the person on the other side of that optimistic trade.
Okay, the short call. The payoff formula is just the inverse. Now Amex, STK, Rose STK. Notice that big negative sign out front. It's a liability, not an asset. The payoff formula is just the inverse. The max risk is unlimited. I mean, theoretically, a stock price can rise to infinity. If you are short a call without owning the stock, your potential losses are infinite. The payoff formula is just the inverse, and the P&L profile is therefore limited upside. The absolute best case scenario for the writer is that the stock drops, the option expires worthless, and they get to keep the premium. That's it. They can't make a penny more than the premium they collected. It's a strategy of hoping for a lot of small wins and avoiding one catastrophic loss.
That sounds absolutely terrifying. Okay, next up, the long put, the insurance buyer.
So the long put. The payoff formula is max, KNST, $0.1. Max risk, just like the long call, is limited to the premium paid. And the P&L profile is substantial upside. As the stock falls, you make more money. But notice I said substantial, not unlimited.
Oh, why is that?
Because the stock can't fall below zero. So your profit is capped at the strike price minus the premium you paid. But, I mean, that's still usually a huge return percentage-wise if a stock completely crashes.
Right, it can't go to negative infinity. And finally, the short put. The person selling that insurance.
The short put. The payoff formula is, again, the inverse, double max, KSD. The payoff formula is, again, the inverse. The max risk is substantial. If the stock goes all the way to zero, you are forced to buy a literally worthless asset at the strike price. If the strike was $100, you have to pay $100 for something that's worth zero. You lose $100 per share. The payoff formula is, again, the inverse. And the P&L profile is, again, limited upside. The best you can possibly do is keep the premium you were paid at the start.
So if we connect this to the bigger picture, the buyers are paying a premium for limited risk and potentially very high upside. The sellers are accepting potentially very high risk in exchange for a limited but guaranteed cash payment upfront.
Correct. It is a direct transfer of risk. The seller is acting as the insurer. And, insurance companies make money because most houses don't burn down on any given day. Option writers make money because, most of the time, stocks don't move enough to make the options they sold all that valuable. The writer is betting on time and stagnation. The buyer is betting on movement and volatility.
So what does this all mean for the actual market structure? We know what the contracts are, but how do they trade? Hull talks about asset classes and contract sizes. This feels like the kind of fine print that really bites new investors.
It is absolutely the fine print, and it's critical. You can trade options on all sorts of things. Stocks, foreign currencies, indices like the S&P 500, even on futures contracts. But the most common one for the individual learner is the stock option.
Okay.
And here is a critical detail: the contract size. One standard stock option contract in the U.S. covers 100 shares of the underlying stock.
This is a huge gotcha for new investors, isn't it? I've seen this happen to people.
It is a massive gotcha. You're looking at a quote screen on your trading app. You see Nebula Tech call options trading for, say, $4. You think, great, I've got $5 in my account, I'll buy one.
Yeah.
No, that price is quoted per share, but the contract is for 100 shares. So that one contract actually costs you $400. You have to be incredibly careful with that decimal place.
So whenever we see a premium price, we always have to mentally multiply it by 100 to know the actual cash that's going to leave our wallet.
Always. Exactly. And this multiplier, this leverage, also applies to the profit. If that option goes up by just $1, your position value goes up by $100. This is why options can move so incredibly fast. A small move in the stock price can mean a huge percentage move in your account balance because of this 100x multiplier. It amplifies emotions just as much as it amplifies your capital.
Okay, let's decode some more jargon. Moneyness. Traders love to talk about being in the money or out of the money. It sounds like gambling slang, but it has a very specific definition.
It does. It just describes the relationship between the current stock price, S, and the contract strike price, K.
Okay.
In the money, or ITM, means that if you exercise the option right now, you would make a gross profit on the transaction, ignoring the premium you paid to get in.
So for a call,
It means the stock price is higher than the strike price. It's $70. You have the right to buy at 100 when the stock is at 110. You could buy low and sell high instantly. For a put, it's the opposite. The stock price is lower than the strike price.
and out of the money, OTM.
That just means exercising would make no sense at all. For a call, the stock is lower than the strike. Why buy at 100 when the market is 80? For a put, the stock is higher than the strike. Why sell at 100 when the market is paying 120? These options have zero intrinsic value.
And the last one is at the money, ATM.
That's just when they're equal. The strike and the stock price are the same. This is often where the most trading activity happens because it's right on the tipping point. A tiny move in either direction changes the game entirely.
This leads us really nicely to the concept of value. Hull breaks an options value down into two components, intrinsic value and time value. This seems critical for understanding why options cost what they cost.
This is maybe the most important concept for pricing. It's fundamental. Intrinsic value is what the option is worth right now if you were to exercise it. So only in the money options have any intrinsic value. If the stock is at $110 and your call has a strike of 100, the intrinsic value is $10. It has $10 of real, tangible equity baked into it.
Okay, but that option might be trading in the market for $12. Why would someone pay $12 for something that's only worth 10?
Because of the time value.
The hope.
It's the price of hope. Exactly. There is still time left on the clock. The market thinks, hey, it's already at 110, but we still got 3 months left. It could go to 120 or 130. That potential for future favorable movement is worth money.
So the whole formula is just total value, intrinsic value, plus time value. That's it. And that's why even an out-of-the-money option, one with zero intrinsic value, will still have a price. It might be trading for $2. That entire $2 price is time value. It's the pure price of that hope you mentioned.
But hope is a depreciating asset, isn't it? As the expiration date gets closer and closer, that hope has to fade.
Yes. And it has a name. It's called time decay, or its Greek letter name, theta. As you get closer to that deadline, the time value just melts away like an ice cube sitting on a hot counter. At the exact moment of expiration, time value goes to zero. The option is worth exactly its intrinsic value and nothing more. If it's out of the money at expiration, it's worth zero. The hope is officially gone.
Now, here's where it gets really interesting and a little technical. What happens when the company itself changes the rules of the game? What if Nebula Tech does a stock split or decides to pay a big dividend? Does my option contract just break? I mean, if I have a contract with a strike of $100 and the stock splits and is now worth $50, I'm ruined. My contract says I have the right to pay $100 for a stock that's now only worth $50. And that would be incredibly unfair. Hull covers this in detail because it really affects the economics of the trade. The guiding principle of the exchange is something called economic neutrality. The exchange wants to ensure that neither the buyer nor the writer of the option is unfairly penalized or rewarded just because of a corporate action. They want to keep the contract's value the same.
So let's look at a stock split. A classic 2-for-1 split, Nebula Tech is at $100. They do the split. Now, the stock price is $50, but every shareholder has twice as many shares. I'm holding my call with a strike of 100. If the stock is now 50, my option is suddenly deeply out of the money and basically worthless. That seems like a huge problem.
It would be. So the OCC, which is the Options Clearing Corporation, they step in and they adjust the terms of the contract.
How?
If the stock price is cut in half from a 2-for-1 split, the strike price is also cut in half. So your $100 strike becomes a $50 strike. But to keep the total value the same, the quantity of shares the contract covers has to double. So instead of one contract covering 100 shares, it now covers 200 shares.
Ah, I see.
The math is pretty simple. You divide the strike by the split ratio, and you multiply the shares by the split ratio. Let's just check the math. Before the split, you had the right to buy 100 shares at $100. That's a total exposure of about $10,000.
Mm.
After the split, you have the right to buy 200 shares at $50. That's still a total exposure of $10,000. You are economically in the exact same position. The option holder is protected.
Okay, that makes sense. And I assume it's the same for stock dividends.
Yes, a stock dividend, like when a company gives you, say, 25% more shares instead of cash, it's treated effectively like a weird stock split. In that case, it's a 5-for-4 split. They'd adjust the strike down and the number of shares up to keep you whole.
But, and this feels like a big one, what about regular cash dividends? Companies pay cash to their shareholders all the time. If I own the stock, I get the check in the mail. If I own a call option on the stock, do I get that check?
No. Option holders do not receive dividends. And here's the absolute kicker. Standard exchange-traded options are not adjusted for regular cash dividends.
Wait, really? But when a stock pays a dividend, the stock price usually drops by about the amount of the dividend on what's called the ex-dividend date. If Nebula Tech pays a $1 dividend, the stock price usually opens $1 lower that day.
That is correct.
So if I'm holding a call option, the underlying stock just dropped $1 purely because of the dividend. That hurts me. And the exchange doesn't fix this?
Not for regular quarterly dividends. And the reason is it's a known event. The market anticipates the dividend. The option pricing models, like Black-Scholes, they factor in that expected price drop. So you don't get an adjustment to your contract. You get a market price for the option that already reflects the expectation that the stock will drop in the future.
So it's priced in.
It's priced in. However, if there was a massive, unexpected special dividend, like a company selling off a division and paying out $20 a share, the OCC will adjust for that. But for your normal quarterly 50-cent dividend, nope, no adjustment.
That is a critical detail for anyone holding calls through an earnings season or a dividend date. You're fighting against that natural dividend drop. Okay, let's move to part 6. How trading actually works. The real plumbing. We mentioned market makers before. Who are these people? Are they just wealthy guys sitting in a back room somewhere?
Market makers are the grease and the gears of the whole system. If you want to buy a call option on Nebula Tech, you don't have to wait around for, Steve from Ohio to decide he wants to sell that exact same call at the exact same moment. The market maker stands ready to buy or sell from you at any time.
But they aren't just gambling, right? They aren't taking a view on whether the stock will go up or down?
No, not at all. Their business model is not speculation. It's all about volume. They quote a bid price, which is the price they'll buy from you at, and an offer price, which is the price they will sell to you at.
So like bid, $4. Offer, $4.10.
Exactly. And they pocket that 10-cent difference. That's called the spread. Their goal is to immediately hedge away any directional risk they just took on and just keep earning that spread thousands of times a day. They want to be market neutral. They don't care if the stock goes up or down. They just want people to keep trading.
Now, suppose I bought that call, and it's now in the money. I've made a nice profit. Do I have to, call Nebula Tech and demand they give me my shares? Do I actually have to exercise it to get my money?
You can, but you rarely do. Most traders simply execute an offsetting order.
What's that?
You bought the call to open the position. To get out, you simply sell the exact same call back into the market. The difference in price between what you bought it for and what you sold it for is your cash profit. You close out the position.
Oh, okay.
Hull notes in the chapter that the vast majority of options are closed out this way, rather than actually being exercised and having stock change hands. It's just cleaner, it saves on transaction costs and complexity.
But what if I do exercise? Let's say I really want to own the stock. What happens? I bought the option from a market maker, but they might have closed their position ages ago. Who actually gives me the stock?
This is where the OCC, the Options Clearing Corporation, acts as the superhero of the whole system.
Okay.
The OCC is the central counterparty, and this is a vital concept in all of modern finance. When you buy an option, you aren't legally dealing with Steve from Ohio, or even with the market maker. Your contract is with the OCC. The OCC guarantees every single trade. It stands in the middle of every transaction.
Why does that matter so much?
It completely eliminates what's called counterparty risk. If Steve from Ohio sold you a call and then went bankrupt when the stock skyrocketed, you'd be out of luck. Your contract would be worthless.
Right.
But with the OCC, if Steve goes bankrupt, the OCC still guarantees your contract. They make you whole. They are the ultimate backstop for the entire market.
So how does the OCC get the stock if I exercise my call?
It's a lottery system, literally. If you exercise, your broker notifies the OCC. The OCC then looks at all of its records. It sees the giant pool of all the member firms who are short that particular option. It then uses a random lottery system to select one of those clearing members.
Ah,
Hey, member firm Goldman Sachs, you've been assigned.
wow.
That member firm, Goldman Sachs, then uses their own random system to pick one of their clients who is short that specific option. Okay, client Y, you have been assigned. And that unlucky writer, client Y, must deliver the stock at the strike price.
So it's a game of tag. And if you are short an option, you never know when the finger of the OCC is going to point at you and say, it's time to pay up.
Exactly. This is called assignment, and it creates a very real risk for anyone writing options, specifically regarding assignment risk on American options that can be exercised early. If you write a call, you might just wake up one morning to find your stock is gone and has been replaced with cash because you were assigned overnight.
Which brings us perfectly to the final mechanical piece of the puzzle, margin. We've talked about how risky writing options is. The system needs to protect itself. If I sell a call and the stock goes to infinity, I owe a theoretically infinite amount of money. The OCC needs to know I actually have some money before they let me play this game.
Right. And this is the margin requirement. First, let's talk about buying. If you buy an option, there's usually no margin required other than paying the premium in full. You have to pay 100% cash upfront. You can't borrow money to buy options because options are already leveraged instruments. The regulators don't want you putting leverage on top of leverage.
But for the writer, for the seller.
For the writer, it depends entirely on whether you are covered or naked.
Okay, what's the difference?
If you write a covered call, which means you own at least 100 shares of the stock, and then you sell one call against it, the margin requirement is zero, or very, very low, because the stock itself is sitting right there in your account. It acts as the collateral. If you get assigned, the broker doesn't need to worry. They just take your stock and hand it over. The position is fully collateralized.
But what if you write a naked option? If I sell a call on Amazon, but I don't actually own any Amazon stock?
Then the margin requirements become incredibly strict. Hull outlines the calculation, and it's aggressive. It's usually something like 100% of the option proceeds you took in, plus NS 20% of the underlying share price, minus the amount the option is out of the money.
That sounds complicated. What does it mean in practice?
In practice, it means the broker demands you keep a significant pile of cash sitting in your account, often tens of thousands of dollars, just to ensure that if the trade goes badly against you, you don't default. And if the stock moves against you, you'll get a margin call and have to deposit even more cash immediately. If you don't, they liquidate your position instantly, often at a huge loss.
And that is why writing naked options is not for the faint of heart or for the light of wallet. It is a professional's game.
Precisely. It's picking up pennies in front of that steamroller, and the margin is the cost of renting the safety gear to do it.
Okay, we have covered a massive amount of ground. We've untapped the grid, the math, the plumbing, the role of the OCC. Let's try to bring it all home. What is the big takeaway here for someone trying to learn this from the ground up?
I think the big takeaway is that options are incredibly versatile tools, but they are instruments of precision. They're like a scalpel, not a sledgehammer. They can be used for pure speculation, gambling a small amount of money for a chance at massive returns using that leverage. Or they can be used as very conservative insurance hedging a big portfolio so you can sleep at night, which is all about protection. But most importantly, understanding the mechanics, not just the buy low, sell high idea, but the strike prices, the expiration, the time decay, the adjustments for splits. That is what separates a professional from a gambler. When you understand the plumbing, you truly understand the risk you're taking on.
It really changes how you see the market. It's not just stocks going up and down anymore. It's this entire landscape of probabilities and rights and obligations all trading against each other.
It is. And if I can leave you with one final provocative thought to sort of mull over.
Please.
Consider that philosophical difference we started the whole deep dive with, rights versus obligations. In finance, we've seen that acquiring a right, buying an option, always costs you money up front. Freedom, the freedom of choice, has a premium.
Right.
And accepting an obligation, like in a futures contract or by writing an option, that usually pays you up front, or at least costs nothing to enter. But it carries the heavy binding weight of the future. So the question is, in life, just as in the markets, is the price of freedom always a premium? Or is there a hidden cost to all the obligations we take on that we just don't price correctly? Are we sometimes too quick to sell our future freedom for just a little bit of upfront cash?
That is something to chew on. Freedom isn't free, and obligations are heavy. And a good reminder to everyone to always check your specific exchange rules because, as Hull reminds us throughout the chapter, The fine print always matters.
It certainly does.
Thanks for diving deep with us. We'll see you on the next one.